Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The major averages snapping a 3-session losing streak, ending the week up for Wall Street. The end of the session, all major indices ending the day higher. Everyone wants AI growth, but can they afford it? Concerns are growing over the AI trade, especially around the revenue that companies like OpenAI are really bringing in. And one estimate out this week highlights a big shortfall. We're going to dig into it. And the clock is ticking on the electric vehicle tax credit. We're just days away now from their expiration, and we're taking a deep dive into the outlook for zero emissions cars. Well, August saw the highest sales of electric vehicles this year, up 19.4% from July, and since January, EV sales are up 61%. But some industry analysts fear those high voltage sales could be short-circuited after tax credits for EV buyers expire on September 30th. Joining me now is Kevin Roberts, CarGurus Director of Economic and Market Intelligence. Kevin, good to see you as always. Maybe start big picture, Kevin. What is the story with tax credits? They've boosted sales so much. Kevin, why are they going away? Explain that for us. And have folks been, have you seen them rushing in ahead of that deadline?
Yeah, so as part of the big, beautiful bill, the expiration of the tax credits was pulled ahead to September 30th. And once that was announced, we really started to see the momentum start to pick up from consumers looking to get ahead of that tax credit expiration. So that's both on the purchase of vehicles and also is helping out EV leasing as well. So I've been calling it an EV crescendo as consumers really look to get ahead of get their sales in before that credit expires.
And Kevin, we did see Tesla update its website saying, order by September 30th. This included even a countdown clock on the site. Kevin, how are some of the other automakers? Do we know? Do we have line of sight there? How are they trying to kind of build awareness, get people in the door, in the showroom?
Well, I mean, I can say from our data, you can see that the sales rate has picked up. And then not only that, the amount of, the number of EVs on dealer lots has been declining, and the market day supply has dropped quite significantly. From where we were, at the end of June, 108 days supply, and now we're under 45 days supply. So the message is clearly getting out to consumers, and they're looking to kind of snap up those EVs before that credit expires.
So now bottom line, Kevin, so now let's look ahead. So once we're past this tax credit, pull out your crystal ball. What do you think the EV market looks like ahead, Kevin? What would you expect to see?
So it's unknown. I've been taking a look at what happened in other markets where tax credits expired. If you look to Europe, you saw double-digit declines of EV sales afterwards. California is one we've been watching. It accounted for about 30% of EV sales last year. And there had been talk that they would be replacing the tax credit themselves, but recently it just came out that they're not going to be replacing that tax credit. So a large EV market that we could be seeing a drop in sales volume in.
Are there certain EV names, Kevin, EV makers that in your opinion, hey, these guys, they may be better positioned than others in a sort of post-tax credit world?
So normally I would have assumed that automakers might be looking to plug the gap themselves, but we're in a post-tariff environment, and that tariff tax bill, they're currently consuming most of themselves right now. So I don't know how much automakers are going to be able to really kind of foot the bill as those EV tax credits go away.
And Kevin, by the way, what does the used market for EVs look like? You have line of sight there?
Yeah, so there is a used EV tax credit. It's for vehicles under $25,000. So we've been seeing an acceleration in that market as well. Not as much as what we've been seeing in the new vehicle market, but there has been an uptick in that used EV market. And we've been seeing a lot more used EVs, particularly get under that $25,000 threshold. And so it's a small but growing market.
We've been talking here about EVs, but let's kind of like broaden out this discussion a bit. Look at that larger car market, Kevin, so gas, hybrid vehicles. I saw J.D. Power site is saying they think sales expected to actually contract in September. Do you agree with that, Kevin? And if so, what would be the reasons for that? Is that just higher rates, higher prices, both?
I mean, we've been seeing almost a pull ahead in vehicle sales the past couple months. We saw that at the end of March, early April, when the tariffs were first announced. There was a lot of kind of looking to get ahead of those pre-tariff prices. We saw, an acceleration of sales in July and August as well. as consumers, didn't see prices increase and were looking to get out there as well. So there is a concern about potential pull ahead of sales volume, but when and where that might strike is a little bit uncertain at this point.
Kevin, you mentioned tariffs. Just want to end here on that, and just your sense of how they factor into this discussion, because you have trade agreements, frameworks with the UK, EU, Japan. I mean, they do provide for this the 15% tariffs. Is that, in your opinion, Kevin, is that manageable for the industry?
So we've already been seeing automakers absorb a lot more of the tariff costs than what I initially expected. I think most people were initially expecting. We can see with trade data, the tariff rates are there and the tariffs are taking effect. So the trade deals that are going to be announced will help to kind of bring down that rate and will provide more room for automakers to potentially absorb those tariff costs for a longer period of time than what we might have initially thought when the tariffs were initially brought out in March.
Kevin, great to see you as always. Thank you, sir.
Thanks for having me back.
Stick around. Much more As for a Trend still to come. U.S. stocks bounce after a 3-day slide, but still ending the week lower. For more on the trade day takeaways, let's get to Yahoo Finance's Jared Blickery. Jared.
Thank you. I was going to start with a weekly recap, but the major indices really not doing that much. So I thought we'd just talk about Apple, which finally turned green this week in 2025, and it kind of came alive recently. And by the way, if you're into seasonality, October is supposed to be a really good month for Apple, and the back half of September is when it starts. So here's the year to date. You can see it was negative today, but up a whopping 2%. But this is what it's done from the lows, and you can see while Tesla and some of the others were just kind of rocketing out of there, it took Apple a little bit more time. And by the way, Tesla actually turned green last week. I mentioned that around the bell. So Apple has been lagging, but maybe it's going to fulfill its destiny, its history as being a leader in October. That remains to be seen. So we got some other concerns there, but let's just look at what happened with the Mag 7 this week. Amazon is another interesting story, down 5%, had some concerns with the FTC, Meta and Alphabet down, only Nvidia and Tesla in the green there. So the AI trade and tech kind of took a back seat this week, but we saw other things assert. So in my mind, it was just another case of rotation. We're about to finish the month of September, and finally that negative seasonality rolls off, and we can look forward to October, which is primetime crash season. Doesn't mean it always has to happen, but that's when you see some VIX spikes, just saying.
So bottom line,
yes,
stocks a little lackluster this week. Okay, what was on your radar?
I'll tell you what, those metals, they are looking precious. And let's just take a look at some of the moves that we saw this week. And I talk about gold quite a bit, even silver. But if we look at the 5-day totals here, platinum in the upper left, that's up 11.4%. Palladium, another metal I don't talk a lot about, that was up 9%. Then is silver up 5.8%. And somewhere in here, here's copper. We talked about copper the other day, 4%. So in this inflationary environment, and we are in an inflationary environment because we learned PCE is what, 2.8, 2.9% today. The Fed's target is 2%, and the Fed is cutting rates. That is a great time to be buying metals, to own metals. And you know what? I had the chance to talk to Kenny Glick. This is right. We had 3 clips from him in a row. This is the 3rd day, and we were talking about him with silver the other day. I thought this would be just perfect. Take a listen.
Put a dead logo on a silver coin, I'm in. So I if you want to own SLV, it's an easy way to own silver, but the easiest thing, and again, if you like collecting silver coins, they're called silver rounds. You don't have to buy the Eagles because the Eagles are the U.S. government official coin. They have a little premium, but you could just buy 1-ounce rounds. You get them for $1 over spot. And it's a nice way,
But if you're doing that your whole life, like storage, where are you putting all this stuff?
Your mom's house. Yeah. Exactly. My mom's like, when are you coming to get all this stuff? I'm like, I just brought you more.
Yeah, he just brought more to his mom's house. So anyway, so you can, silver, actually, if you want to store a large dollar amount of silver, it's going to take up some space. So that's why I think investors turn to gold, platinum, and palladium, because much smaller there. So I think we're done with metals for just the time being.
What about that crypto sell-off?
Let's talk about that. Bitcoin has taken a beat, admittedly. Not a big change from yesterday. Yesterday, we were talking about that big drop. We saw some big-time liquidations. But today, I just kind of wanted to talk about the price dynamics that have evolved in this President Trump term, because we have a much more friendly SEC. And I think it was in early 2020. was it 2025 or 24 that we finally got those spot Bitcoin ETFs? My brain isn't keeping track of that. But my point is that we have a lot of things kind of in a loop here. And so when you start deleveraging in one, you got the futures, you got MicroStrategy, you got MicroStrategy that's levered. And it's just kind of crazy how much leverage is built into this already volatile trade. So the fact that, let's check out the 5-day total here. The fact that it's only down 5% is really not a big deal in the long term, in the big scheme of things. Again, I'm watching the 110 price level, give or take 1,000 or two. I would love to see it dip down to like 107, 108 over the weekend and then just rocket higher and be about 112, 113 by Monday. That would be a very bullish signal to me. But if we camp out by these lows too long, we're probably going to sink and we're going to have to chop around. Maybe we test 100 again. And then we have Ethereum. Ethereum down 4.5%. We still have a potential support level right here, about 4,000. That's a big psychological level. I think that holds in the near term. But if Bitcoin tests 100,000, especially if it slides below that, watch out because Ethereum could drop pretty quickly there. So Ethereum is not as levered as Bitcoin, but it definitely follows the same playbook. And if you're keeping track of the whole board here, we didn't see a whole lot of green, a couple there, but for the most part, it was kind of an off week. So I do like to see breadth in crypto, and that's not really what we saw this week.
Finally, what's on the Jared Blickery radar for next week?
Jobs, and also be interested Monday, Tuesday to see how September closes out. We tend to see the biggest weakness at the end of the month, and we're kind of there right now. We had a positive day, but that's just history. So we'll see what history says 1 week from now.
Thank you, buddy. Appreciate it. Stick around. Much more Ask for a Trend still to come. Bain & Company's 2025 Global Technology Report shows the build-out of AI data centers will require roughly $500 billion in annual capex and $2 trillion in annual revenue. In 2024, the combined annual revenue of the Magnificent Seven was just $1.8 trillion. Joining me now with more, we got David Crawford. He is chairman of Bain & Company's Global Technology Practice. David, it's good to see you. So let's dig into this report, David. So you say by 2030, AI companies are going to need $2 trillion in combined annual revenue to fund the computing power needed to meet demand. But you say revenue is going to fall $800 billion short of that. Just explain us how you get to those numbers, David.
Yeah, I think basically if you take today's scaling laws and just play them forward, and we don't know if they're going to have the same longevity as Moore's Law, 40 years, but let's say they last at least 5 years, and you play those forward to 2030, then the amount of computational sort of power you need to serve that workload in 2030 adds up to a capital bill of about $500 billion a year. And if you play around with reasonable self-sustaining business models, that translates to about $2 trillion of revenue or some kind of payback to fuel that $500 billion a year. And so I wouldn't say it's 800 billion short. I think what we said is, okay, if you take what AI is being used for today in the enterprise context, driving productivity, improving employee sort of output and so forth, and you apply it everywhere. Today, only about 10% of companies have gotten much out of it. But if you apply that everywhere, you only get about halfway there. That doesn't mean that we're short on revenue. What it means is we're going to have to start using these extraordinary machines to do things besides driving employee productivity. We're going to have to drive growth faster. We're going to have to come up with ways to influence health and welfare of society. We're going to have to improve on drug discovery rates, et cetera. And I'm confident we will, but we have to do that in that 3 to 5 year time frame to keep it going. Does that make sense?
So yeah, just to make sure I understand you. So the shortfall is because, make sure I get this right, you say the monetization of the AI services is going to trail the spending requirements needed for the infrastructure, the data centers. Is that the right way to think about it?
We don't know that. What we know is that if you just use them for what we're using them for today, which is in the enterprise context, largely productivity, it won't be enough. And so we have to use them to solve major, significant human problems.
You also talked, David, in the reports, interesting about the possible choke points, the hurdles for AI. Walk us through some of those. Fast forward to power supply, you talk about supply chain constraints.
Yeah, again, if you take that, forecast and the scaling laws that are in place today and you play them forward to 2030, you end up with data centers that are very large and consuming an enormous amount of power. And so as a technology partner, I'm getting more and more calls to speak with utilities and builders and so forth, because they're looking at that forecast and thinking, wow, can we really rely on that? So we've done a lot of work that goes back into the supply chain and says, okay, where do we have pinch points? Where do we have choke points that won't be resolvable? Where do we need to send demand signals into the supply chain so that we get those resolved ASAP? And there's a lot, but the big categories are power, as you mentioned, just the amount of power that we will need to drive these data centers on a grid that hasn't really added much power for 2 decades. It gives everybody a bit of vertigo. That's going to require some real planning, and location matters a lot. Second are, just services. It turns out building these will become some of the biggest projects in their continent, at the time they're being built. And so we'll be short on electricians, plumbers, carpenters, et cetera, tradespeople who can actually build these things. And so they'll have to be moved geographically to get them in. And then there's a third category, which is just all the stuff we hear about in the news. Like, are there going to be enough GPUs? Who gets the GPUs? Who doesn't get the GPUs? Silicon photonics is a pinch point. So there's a lot of very critical pieces of the supply chain that have to make sure that they come together at the right time.
In addition to AI services, David, in the report, you also dig into other areas like quantum computing. Obviously, that's an area investors have been interested in, excited about. I'm curious, David, what do you all think the adoption curve for quantum computing could look like, and what industries do you see it potentially impacting?
Yeah, great question, Josh. I think, look, I get asked all the time, well, can't we solve this AI compute problem just using quantum? And our answer to that is no. Quantum has been on our long-term kind of watch board for a while, and we only took it off and put it into the 3 to 5 year relevant category this year because not because of its computational ability to solve AI workloads or anything like that, but more because in that time frame, it will start to be relevant to security. And so in that time frame, we'll start to see the use of quantum computing to crack cryptography, and we need to evolve and find solutions to a post-quantum cryptography environment.
You've had a front row seat, David, into a number of tech revolutions. You've watched mobile and internet and cloud. How, in your opinion, David, how does AI sort of fit in there? In your opinion, is it a true paradigm shift?
Yeah, Josh, thank you. It was a delicate way of telling me that I'm old, but yeah, I have seen a few of these. And I would say, first of all, it's big. It's really, really, really a big wave of innovation and human impact. And so I think relative to all the ones that you mentioned, I think it's dramatically larger. But second, I think it's a much more complex innovation pattern. This time around, cloud came and went, and a handful of American and Chinese companies made the vast majority of the profit pool, and it was located in relatively predictable geographies. I think this will be very different. We've got the dynamic of sovereigns wanting their share of it. I just got back from Europe, and like about 100 CEOs, the number one question I got is, how can we make sure we don't have another cloud where all the money ends up in American and Chinese pockets? So there's a sovereign layer. Also, most sovereigns around the world can't actually build their own technology stack. It's not realistic for them at this time. So there's a huge amount of partnering and licensing that's going to happen, which adds in a layer of complexity. Meanwhile, there's decoupling dynamics in the supply chain, China, US being the most notable, but there are others as well. And so those decoupling dynamics create a more inherent fragmentation, And so I think A, huge, B, much more complex and diverse sort of innovation patterns.
David, great to see you. Thank you for your time. Enjoy the weekend.
All right, take care, Josh. Bye-bye.
Well, that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moon stories affecting your wallet.